Welcome back, everybody. In this module, we are going to discuss in detail how to value a business, how to find out the intrinsic value of a business. But to be able to do that, we will spend some time discussing the concepts of the time value of money. Now, I fully appreciate that for some of you, you're already very well aware of what this means. So feel free to skip this section of the module and go directly to the intrinsic value calculation. Now, the basis of any valuation of any asset, it doesn't matter whether it's a business, whether it's a real estate asset, whether it's a farmland, it basically boils down to evaluating the present value of all future cash flows. And to be able to do that, we need to understand what time value of money is. Now, let me give you a scenario. Let's say you are asked to invest $1,000 today, and over the next 4 years, you receive these cash flows. So whatever is below the timeline, that is your outflow, that's shown as a negative. And whatever is above the timeline, that is your cash inflow. So you receive a cash inflow of $400 every year over the next 4 years against your investment of $1,000. Now, is this a good deal? So this is scenario A. In scenario B, you invest $2,000 today and you receive the cash flows as shown in the diagram. 400, 500, 600, 700, and 800 over the next 5 years. And these add up to $3,000. In scenario C, you invest $2,000 today, and again you receive a total cash inflow of $3,000 spread over the next 5 years. However, the order has been reversed if you notice carefully. In year 1, you receive $800, and that goes down to $400 in year 5. Now, which one of this is a good deal and which one is not so good deal? To be able to understand that, we need to understand the concept of time value of money. Now, the most important thing to keep in mind is a certain amount of money received today is not same as the same amount of money received a year from now or the same amount of money received 2 years from now. These are not equivalent scenarios. Now, they could be equivalent scenarios if there is absolutely nothing to lose if you're receiving the same amount of money in future instead of receiving it today. And that happens when the interest rate is 0 or when the opportunity cost of not having the money today is 0. Now, we all understand that the value of $1,000 a year from now becomes $1,000 multiplied by 1 plus R, where R is the opportunity cost or where R is the interest rate. So if you put $1,000 in a bank account, if the interest rate is 5%, then the value becomes 1,000 multiplied by 1.05, which is $1,050. So similarly, the value of the same amount of money 2 years from today becomes 1,000 multiplied by 1 plus R multiplied by 1 plus R. So we all know this. So if we extrapolate this to T years from now, then the value of the same $1,000 becomes 1,000 multiplied by 1 plus R raised to the power T. So that is the future value of the $1,000 T years from now. And when we try to calculate the present value of $1,000, that is $1,000 received T years from now, the present value of that, you can see algebraically it becomes 1,000 divided by 1 plus R to the power T. So that is how you calculate the present value of any cash flow that happens in the future. Here R is the discount rate, which is nothing but the opportunity cost, and T is the time in number of years. Now you all can understand this, that higher the interest rate, higher is the future value of any amount of money. So let's take the example of this $1,000 which you park in a bank account. Now, the value of that $1,000 10 years from now will be significantly higher if the interest rate is 10% as compared to 5%. So as you can see from the formula of future value, which is nothing but the compound interest formula, time plays a much heavier role in arriving at the future value than the discount rate, simply because time is the exponent. So just to demonstrate the power of this, I'll tell you a story. Peter Minuit, who was the third director of Dutch North American colony of New Netherlands, negotiated the deal to purchase Manhattan Islands from the Native Americans for a princely sum of $24 in 1626. So that tells you the power of time in arriving at the future value of any investment. So going by the same logic, if I tell you that you are supposed to receive $1,000 10 years from now, if you invest a certain amount of money at a certain rate, so higher the rate is, lower the amount you have to invest today. As the discount rate R is in the denominator, so higher the value of the discount rate, lower is the present value. And as T is in the exponent, so higher the value of the T, the present value is going to be even lower. So the present value of the distant cash flows are going to be much lower as compared to the present value of the near future cash flows. So $1,200 received over 3 consecutive years is not same as $3,600. So you cannot add money across time, and that is the most important thing to keep in mind when you try to understand the principles of time value of money. If you want to find out the value of these 3 cash flows today, what you need to do is you need to add the present value of the future inflows with the $1,200 that you received today. In the 3 scenarios that we talked about earlier, the only way for us to know if it is a good deal or a bad deal is for us to compare the present value of what we are getting over time versus the present value of what we are parting with. So I would encourage you to assume different interest rates. Start from a very low interest rate of say 1% and keep going up to say 15%, 20%. That is the value of R, and see how the 3 scenarios that I talked about work out. So if the present value of your future cash inflows is greater than the present value of your cash outflows, that's a favorable scenario. So if I bring you back to these 2 scenarios that we had discussed, the scenario B as compared to scenario C. Now, for any particular discount rate, the present value of the cash flows of scenario C is expected to be higher than that of scenario B. And the reason is very simple. As we have seen in the formula, that the time is in the exponent. So in scenario B, the higher cash flows are happening in distant future, whereas in scenario C, the higher cash flows are happening in near future, which means the present value of the $800 happening 1 year from now is going to be a lot higher as compared to the present value of the $800 that is happening 5 years from now in scenario B. So to sum it up, the only way for us to know if the deal is a good deal or a bad deal is for us to compare the present value of what we are getting over time versus the present value of what we are paying. So if the present value of the cash inflows is greater than the present value of the cash outflows, then it's a good deal. If it's the other way around, that is the present value of the cash inflows is lower than the present value of the cash outflows, then it's a bad deal. And if the present value of the cash inflows is exactly equal to the present value of the cash outflows, then it's neutral. It's neither good nor bad. So in any investment where you are investing a certain amount of money upfront, so we have represented a standard investment in this time series where we are investing an amount of P0 upfront, which is today, and subsequently every year we are receiving a certain cash flow as demonstrated here. Now, the cash flow timeline could also look like this. I mean, there could be further cash outflows in future, or it can even look like this where the cash inflows might not be equidistant from each other. But at the end of the day, the net present value of this investment is nothing but the present value of all the cash inflows minus initial investment that we have made. And if that net present value is greater than zero, then it's a good investment. Whereas if the net present value is less than zero, then it's not a good investment. So this brings us to the calculation of intrinsic value of any asset class. That is nothing but the present value of all its future cash flows. So that's the reason when we evaluate a stock for investment, we try to arrive at the intrinsic value, and it is very important for us to ensure that the price that we are paying for the stock has to be lower than the intrinsic value of the stock, and only then the net present value will be greater than zero, and it would make sense to invest in that stock.